Welcome to This Explainer, everyone. Today, we are taking a definitive deep dive into the absolute engine room of modern finance. We're going to completely unpack the technical mechanics, the rigorous math, and the structural realities that define private equity in 2026. This isn't just about high-level trends, right? This is about really popping the hood to see exactly how these vehicles are built, how they generate those outsized returns, and what it actually takes to keep them on the road in an incredibly demanding market.
Okay, let's kick things off with a number that'll make you do a double take. $55 billion. That was the size of the record-breaking take private of Electronic Arts. And honestly, it perfectly illustrates a fascinating reality about our current market. While the fog of recent years, the dampened deal-making, the crazy macroeconomic uncertainty is finally cleared, the terrain of private equity is honestly more demanding and technical than it has ever been. We are absolutely seeing mega deals return in full force, but the environment right now requires incredible precision. The old days of just relying on cheap leverage and simple multiple expansion, those are completely in the rearview mirror.
So to understand how the best firms are actually winning today, here is our roadmap. We'll start with the 2026 terrain, move into the PE fleet, break down LBO deal mechanics, look at value creation math, and wrap up with frictions and future realities.
Section 1. The 2026 terrain.
So we are currently navigating a landscape defined by persistently high interest rates, and median purchase multiples are resting at a super steep 11.8 times EBITDA. Assets have literally never been more expensive, and as a direct result, just consider the sheer scale of the current industry backlog. Right now, there are over 16,000 PE-owned companies globally that have been held for more than 4 years. That is 52% of the total buyout inventory. Because of this massive logjam, limited partners, the LPs, are shifting their focus heavily. They're looking away from IRR and moving straight toward DPI, which is distributions to paid-in capital. Basically, they don't just want paper returns anymore. They want cold, hard cash back. This intense liquidity pressure is fundamentally reshaping how general partners have to operate to execute their mandates.
Moving right along to Section 2, the PE fleet. The industry spans a really wide, highly specialized spectrum. It's not just one thing. You've got the high-risk, early-stage engine of venture capital. You have growth equity, which scales up proven concepts. You have mezzanine funds, acting almost like shock absorbers, but providing high-yield debt. And then you have the heavy-duty haulers, mature leverage buyouts, which is exactly where we're going to focus our attention today.
Now, the crucial point here is the massive contrast in acquisition structure. Think about it. While venture capital takes minority stakes in risky early-stage startups that have a pretty high failure rate, a leveraged buyout fund operates on an entirely different planet. An LBO fund acquires 100% of a mature, cash-flowing company. They pull this off using a carefully calibrated mix of debt and equity, with one very highly specific goal: take absolute control, improve the company's operations, pay down that debt, and get out. Exit the investment in 3 to 7 years.
Section 3. LBO deal mechanics.
Let me tell you, these deals move at absolute lightning speed. A typical origination and execution process, it goes from initial due diligence and a principal activities memo in week 1 straight through to securing the mandate in week 2. By weeks 3 and 4, you are already knee-deep into full documentation, legal counsel, and the marketing strategy to syndicate the debt. It is a highly compressed, incredibly intense period of execution where structural precision is absolutely vital to actually closing the transaction.
And the actual plumbing of how capital flows here is brilliant. The sponsor doesn't just buy the company directly, that's not how it works. Instead, they inject cash equity into a newly formed shell company, which is usually referred to as NewCo. At the exact same time, NewCo issues debt to banks or public bondholders. It then uses that combined capital pool, so the injected equity plus the newly raised debt, to acquire 100% of the target operating business.
But you've really got to compare this traditional LBO structure to a leveraged recapitalization. Why? Well, while they are economically similar in that they both use debt to extract cash for shareholders, a recap requires approximately a 10% equity rollover from existing holders. More importantly, though, because it's structured as a recapitalization rather than a completely new purchase, it avoids the creation and amortization of goodwill on the balance sheet. And skipping that goodwill amortization generally results in significantly lower EPS dilution. Understanding this structural distinction is absolutely critical for dealmakers who are mapping out an eventual exit strategy, especially if that exit involves the public markets, where earnings per share is heavily scrutinized.
Let's move to Section 4, Value Creation Math.
So how do they actually make the money? Value in private equity is fundamentally generated through 3 main pillars. First, operational improvements that drive up EBITDA, things like cutting excess costs or scaling revenue. Second, the use of leverage, specifically paying down debt over time to aggressively grow the equity share of the business. And third, multiple expansion, which is basically relying on selling the business at a higher valuation multiple than what you paid for it on day one.
But leverage works on a much deeper mathematical level than just, utilizing other people's money. It actually works by actively lowering the firm's weighted average cost of capital, or WACC. This happens through what we call the tax shield. Because the interest expense paid on that massive debt load is tax deductible, the true cost of that debt is mathematically reduced by the corporate tax rate. This neat little mathematical reduction is a cornerstone of exactly why leveraged buyouts can generate such outsized returns compared to unlevered investments.
Which brings us to a really vital question you might be asking. If an unlevered asset only yields a 10% internal rate of return, which, let's be honest, absolutely does not justify the risk of a private equity investment, how exactly does the math bridge the gap to hit the massive 20% to 25% returns that LPs are demanding, especially in today's high interest rate environment?
The answer, both historically and structurally, is delevering. Just consider this growth trajectory. As the portfolio company uses its operating cash flow to aggressively pay down the principal on its debt over a standard 5-year holding period, the sponsor's equity value grows exponentially. We're talking growing from $59 million in year 1 to $96 million in year 5. And here is the absolute kicker. This massive equity growth happens even if the overall enterprise valuation of the company never changes by a single dollar. The equity slice simply expands dynamically as that debt slice shrinks.
Finally, Section 5, Frictions and Future Realities.
Now, a major structural reality of private equity involves the mechanics of profits interest, which you've probably heard called carried interest. The literature points out that this structure effectively allows fund managers to swap current ordinary income for future long-term capital gains. Academic reviews, like the ones out of the University of Chicago, describe this strictly as a joint tax arbitrage with tax-exempt investors, where the more lightly taxed form of income is shifted directly to the manager. Understanding this specific mechanical advantage is crucial if you want to analyze the historic profitability and alignment incentives of the entire private equity partnership model.
Which leaves us with this final provocative thought. We are entering a landscape right now where artificial intelligence is fundamentally reshaping how operations are run, crashing headfirst into a high-interest, low-liquidity macro environment. With holding periods stretching far beyond historical norms and operational alpha entirely replacing financial engineering, you really have to ask, can the traditional 5-year leverage buyout model survive in its current form? Or must the entire private equity vehicle be fundamentally rebuilt for the train ahead? Thank you so much for joining this explainer.